The week starts with limited risk appetite after last week's FOMC minutes hammered the dovish Fed expectations, and while G7 leaders raised their voices against cheap Chinese goods at their weekend summit. So the week will bring some fresh inflation data from both Europe and the US in focus, while OPEC is expected to announce the extension of the supply cuts to the second half of this year. So welcome to the new week of trading with Swissquote's daily market talk. Well, we are having a roller coaster month of May in terms of Fed and other central bank expectations. The month began with the Federal Reserve's decision to hold its interest rates steady, remember, and Jerome Powell saying that the Fed's next move will probably not be a rate hike. So that sent the markets rallying with enthusiasm at the start of this month. Then, the US jobs data came in softer than expected by analysts, and inflation didn't surprise to the upside for the fourth straight month in the US, although producer prices came in hotter than expected. And well, the Federal Reserve members just kept giving hawkish speeches one after the other since the latest FOMC decision, repeating insistently that the interest rates in the US are good where they are, and that cutting them is not necessarily a good idea. And Marcus Bull had an ear on the avalanche of these hawkish comments, but without necessarily putting too much focus on them. Until last week's FOMC minutes actually revealed an inconvenient truth, which was that, many Fed members actually question whether keeping the interest rates high for longer is enough restrictive to continue the inflation battle in the US, and if hiking rates wouldn't be more effective. And the mood finally darkened last week on these minutes. So this is where we are standing right now. While last week began on optimism that inflation could allow the Fed to cut the interest rates as early as in September, while this week begins on pessimism that the latter will probably not be possible. So the US markets are closed today, but the US 2-year yield ended last week near 4.95% level, and the probability of a September rate cut from the FOMC fell to a coin flip. But regardless, the US stock markets continue to trade near record high levels. The S&P 500 and Nasdaq 100 indices both closed last week a few points below their all-time high levels, boosted by a fresh shot of energy after Nvidia reported another set of blowout quarterly results and a strong forecast as well. So under these conditions, it will be hard for the technology rally to expand to the rest of the market, but that does not necessarily mean that the technology rally will stall due to the re-rising yields. And something that the rally in stock markets is tired, and an analyst at Bank of America says that near 70% of equity indices trade above their 200-day moving averages, and that a rise to 88% would be a contrarian sell signal, but we are not there just yet. And despite the elephant in the room, investors still want to believe that the rally will expand further and toward the rest of the sectors. And after all the data and hawkish Fed minutes and the comments that we heard last week, Friday's slight improvement in the US inflation expectations were simply enough to help the S&P 500 rebound. But anyway, the week starts with limited optimism, and this cautious tone should last until the second half of this week, where we will have a fresh update on the US latest GDP data and Federal Reserve's favorite gauge of inflation, which is the PCE index. So the GDP update for the first quarter in the US is expected to show a slower growth and higher price pressure, so only the core PCE for April could save the day if it shows a certain easing last month, as it is suggested by data released earlier this month, remember. But in both cases, buying on the Federal Reserve optimism, on rate cut optimism, wouldn't make sense when inflation is still at the levels where the Fed simply can't consider cutting the interest rates. In China and nearby, while the CSI 300 and Hang Seng indices are better bid this Monday morning following a correction last week, which actually brought sellers back to the market before the Hang Seng index got the opportunity to test that 20,000 psychological resistance. Now, the Chinese stimulus measures to prop up the economy and slow the bleeding in the property sector are supportive of gains, but the rising tensions with the West are threatening the Chinese companies' future revenue expectations. And in this beautiful context of rising trade tensions between the China and the West, because the G7 economies are simply not in a good shape right now, well, G7 leaders took the opportunity to further escalate tensions with China at their weekend summit after the US reimposed tariffs on hundreds of Chinese goods, as the US President Joe Biden's only hope to improve his popularity for the November election lies there. So China's EV makers are on the front line in this trade tensions, as China became the world's biggest car exporter, and while their electric vehicles are obviously cheaper than the Western peers. So the latest news are about to derail the BYD's stock rally. The stock is now preparing to test the 200 support to the downside. Now, here in Europe, investors will also be focused on fresh inflation data this week for May. The headline inflation in the Eurozone may have advanced from 2.4 to 2.5%, while core inflation is seen steady near the 2.7% level. Now, the European Central Bank is expected to start cutting the interest rates next month, regardless of what the Fed will do. Therefore, if the data shows no surprise this week, that dovish divergence between the European Central Bank and the Federal Reserve should prevent the euro-dollar from clearing the 109 offers against sterling, while the euro is sitting on a critical support, which is the 0.85 level. A hotter than expected inflation report from the UK while brought the Bank of England hawks to the battlefield last week, remember, but obviously these uncertainties surrounding an upcoming and probably a too early general election in the UK will hardly let the pair gain momentum below this 0.85 level. So the 0.85 level could actually be an interesting dip buying opportunity for those investors who don't think that the European Central Bank will continue to lead this dovish expectations beyond the June meeting, where they're expected to cut the rates. Elsewhere, while the yen is slightly better bid this Monday morning, as the Bank of Japan Governor Mr. Ueda said that he doesn't have a big problem after the Japanese 10-year yield hit a 12-year high last week. And if the BOJ leaves the yields to themselves, well, obviously north is the only possible direction for the yields, as the country's debt to GDP ratio is at least double the other G7 nations. But we know that they won't do that, and we also know very well that the Bank of Japan can sustainably counter the Japanese yen sell-off. So buying the Japanese yen still doesn't look convincing to me, but buying the Japanese stocks is, well, still a plausible trade in my opinion. Elsewhere, while the US crude fell and rebounded from $76.40 per barrel level on Friday on waning reflation trade, OPEC countries will meet this week, and they will probably announce to extend their supply cuts into the second half of this year in an attempt to set a floor under the actual sell-off that we see in oil prices. But if the global central banks don't play along, well, it will be quite hard for OPEC to keep oil prices sustained. So US crude could actually extend losses toward the $75 per barrel level this week if OPEC fails to boost appetite at this week's announcement. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.